Is AT&T finally turning the corner, or are investors just falling for another dividend trap? With Q2 numbers out, the picture is getting clearer, and you might be surprised by what's actually driving growth. With roots tracing back to 1876, AT&T offers wireless phone services and broadband internet in the United States. The company primarily earns revenue by offering monthly wireless plans for mobile phones, charging for data and internet subscriptions, and selling or financing smartphones and devices. AT&T's large network supports fifth-generation 5G services and fiber-optic internet, delivering fast and reliable connectivity to millions of customers. The company is currently available with a starting dividend yield of 3.94%, compared to a 5-year average of 6.58%. The price-to-earnings ratio now stands at 13.3, while the 5-year average was 8.3, and the sector average is currently 18.7. The expected fair value is estimated to be somewhere between $16 and $19, while the current share price is around $28. Based on these figures, the stock appears to be significantly overvalued at the moment. The company currently pays an annual dividend of $1.11, distributed on a quarterly basis. The next dividend payment is scheduled for August 1st, and to be eligible, shareholders must have owned the stock no later than July 10th. The company hasn't increased its dividend since 2022. In fact, it was cut that year. As a result, the average dividend growth over the past 5 years is minus 11.5%, and over the past 10 years it stands at minus 5%. The earnings payout ratio over the past 12 months was 51%, but it's been steadily rising since the 2022 dividend cut, even though the dividend itself hasn't been increased at all. The free cash flow payout ratio is also expected to start climbing again, based on projections for the next 12 months. Both earnings per share, EPS, and free cash flow per share have been declining consistently since 2021, which explains why the payout ratio keeps rising, despite no dividend hikes. This trend is clearly visible on the EPS chart. After the sharp drop in 2022, the decline seems to have slowed, but for long-term investors, even 2 consecutive years of EPS decline can be a strong reason to stay away from the stock. The company has been buying back more shares than it issues for the past 2 years, but the overall share count isn't decreasing nearly as fast as it should, especially when you look at the total sales chart, which shows declining revenue. That alone is a major red flag. Falling sales, combined with a stagnating dividend and weak earnings growth, are enough to make this stock unattractive for long-term investing. The return on equity (ROE) and return on invested capital (IC) charts also paint a disappointing picture, falling below what many would consider minimum acceptable levels. On a more positive note, the company is well above expectations when it comes to operating and free cash flow margins. There's no major concern in that area. In 2022, the company revised its debt policy, recognizing the need to focus more seriously on financial stability. As a result, debt levels are now under control, and the interest coverage chart currently shows performance at an acceptable level. The company is currently available with a starting dividend yield of around 4%. There has been no dividend increase since 2022, and it holds a BBB credit rating, which is considered strong. For now, the dividend appears safe, but the company needs to grow its revenue. Otherwise, another dividend cut could become likely within the next few years. Based on these factors, the stock currently appears to be significantly overvalued. Disclaimer: this video is for informational and educational purposes only. It does not constitute financial advice. Always do your own research before making any investment decisions, and never base a financial decision solely on the content of this video. Let's start with AT&T's main business goals for 2025. The company is focused on 3 key areas: growing its 5G and fiber customer base, with a focus on customer satisfaction and bundled services; boosting efficiency through AI integration, network modernization, and the retirement of legacy copper networks; Smart capital allocation, including a $22 to $22.5 billion investment in 5G and fiber and a $10 billion share repurchase program. In short, AT&T is tightening operations while still investing heavily in infrastructure and innovation. In Q2, AT&T reported 73.4 million postpaid phone subscribers with 401,000 net new additions, 9.8 million fiber subscribers with 243,000 new adds. Mobility service revenue growth of plus 3.5% year over year. Fiber revenue up 18.9% year over year. These numbers show a company steadily growing in high-value segments like fiber and wireless. Financially, AT&T posted $4.4 billion in free cash flow, plus 3.5% year-over-year growth in adjusted EBITDA. Adjusted EPS of $0.54, excluding DirecTV. Margins are holding up well, with EBITDA margins hovering around 38%, indicating solid operational efficiency. Mobility remains a growth engine. Service revenue grew by 3.5% year-over-year. EBITDA also up 3.2%. Postpaid phone churn stayed low at 0.87%. One interesting stat is the average revenue per user, $57.04, showing consistent customer value and stability in pricing power. Fiber continues to shine. Revenue grew 18.9% year-over-year. 243,000 new fiber subscribers, plus 203,000 adds for AT&T Internet Air. Convergence is key here. More fiber customers also use AT&T Mobility, reaching a 40.9% convergence rate. This integrated service model improves customer retention and ARPU, which climbed to $73.26. The business wireline segment is under pressure. Revenue down 9.3% year-over-year, EBITDA down 11.3%. However, AT&T added 398,000 FirstNet connections, showing strength in public safety and business wireless. This is clearly a legacy segment in transition, and losses are expected as copper lines phase out. AT&T is showing discipline here, paid $2.1 billion in dividends, spent $5.1 billion in capital investment, $1 billion in share repurchases this quarter alone. Despite $132 billion in total debt, net debt to EBITDA remains at a healthy 2.64 times. They're also sitting on $10.5 billion in cash, giving them room for flexibility. Here's what AT&T expects for full year 2025. Revenue growth, low single digits overall, 3% or more for mobility and mid to high teens for fiber. Adjusted EPS between $1.97 and $2.07. Free cash flow in the $16 billion range. Capital investment between $22 and $22.5 billion. These are realistic targets in line with current trends. AT&T isn't flashy. It's a mature, dividend-paying, infrastructure-focused company with clear strengths in mobility and fiber. While legacy wireline drags down results, the growth in fiber and wireless more than offsets that. If you're looking for stability, long-term cash flow, and a solid dividend, AT&T is worth a look. Thanks for watching, and if you found value in today's video, give it a thumbs up and consider subscribing for more smart, long-term investing ideas. Stay patient, stay consistent, and keep building your path to financial freedom. Until next time, take care and happy investing.